Welcome to the Value Investor TV podcast. This is the podcast that helps you grow your wealth and become financially independent. My name is Becco and my partner, Hari.
Hello.
This is part 2 of Stamps.com. Glad you guys are here with us. As we talked about in the last episode, Stamps.com is one of the companies that one of our listeners suggested us look at. And if you guys have a company that you want us to look at, please feel free to email us at info@valueinvestor.org. So this is part 2. As we always do, we go through a checklist. If you don't have a copy of our checklist, please email us also at info@valueinvestor.org if you would like a copy. So part 2, usually we cover the financial, the management, and then finally we talk about the valuation, the intrinsic value we cover in this episode. So we'll talk about that, all of that for Stamps.com in this episode. Before we do that, Hari, give us a quick disclaimer, please.
Yeah, this is the Value Investor TV podcast. We are a podcast that educates you on the concepts behind value investing. We don't know your specific financial situation, nor are we your financial advisors, so please consult with the appropriate advisor before making any financial decisions.
Great. Let's get right to it. So the first question, Stamps.com, is the company able to translate its moat into high returns on capital? And before you do that, if you could quickly just recap the competitive advantage that we talked about in the previous episode. Ari.
Yeah, so when we looked at them, I think what we saw was that they are a business that has relatively high switching costs. From going from one kind of provider to another. You integrate your business, your e-commerce platform, your small business that's shipping out mailers. That's the kind of thing that it may be a big part of your business, but you don't have a lot of time or money to spend on it. So you integrate with them once, and then you use it on a day-to-day basis to do what you need to do for your marketing campaigns, mailers, shipping your packages and so forth. So I think the big thing here about Stamps is that because they have a good brand presence, I think we won't discount that, but I think the real impact that they make is that businesses kind of integrate with them, and then they want to, they don't want to do that every day. They want to integrate once and then stick with the company for a while.
So if you could just talk about the moat into returns on capital. You talked about a few different ratios we usually look at. So if you could talk about that here.
Yeah. So what we're going to talk about here is, the traditional one is return on equity, and their return on equity for a business like this is based on the idea that, you look at the assets and the liabilities, and the difference between that is what the owners of the business actually own of the assets. And, they have an equity base of about $665 million, and it was about $600 million in 2018. The return that they saw was, they took a significant nosedive from 2018 to 2019. Net income went from 165 to 59 million. But even so, their return on capital there is, went from about 20+%, return on equity went from 20+% to, around, hold on, what? 30%, it got halved to 15%. But when you start looking at it in the return on capital employed, so return on capital employed is a better metric for a business like this, because it's talking about how much capital do they actually need in their business to make it run. And when you look at a business like this, they have a asset base of, return on capital employed is total assets minus current liabilities. And what you see here is that, they had 900 million in assets. And, when you subtract out the current liabilities, you get about $720 million or so. So it's roughly the same as their equity base. But I think the thing that we see there is they have a large component of their asset base is based on goodwill. And goodwill is, the price above the equity base that they paid for purchasing a business is considered goodwill. And that goodwill is not really contributing to their business in the way that it is being employed to actually run the business. And so a lot of people will take out the goodwill because it will be amortized away over time. So, if you do subtract out the goodwill and, use some percentage of their cash is actually needed and the rest is excess cash, I'm going to just leave the cash alone. That number goes from 720 million down to about 300 million. So they have a very, very high return on capital in almost 50%. So anyway, pretty much however you slice it, they're doing pretty well there. They don't have a whole lot of long-term debt. So it was 50 million in 2018. It's zero in 2019. And they lease an office building, which I'm not, it was like $11 million. So it's not really significant there. So I don't see there being a big, jump that, to be gained here by having more asset, I'll just say it this way. It's a very high return on capital business, but what I'm concerned about is that return is going to be a lot lower than it used to be in the past because their special deal with the U.S. Postal Service is now is gone.
Yeah, I mean you're effectively talking about a capital base of $300 million in the business that are actually being employed and required to run the business.
Right.
And then it's generating what? It's generating, you said...
At its peak, in 2018, they generated EBIT of 200 million, almost 200 million. And in 2019, that was 93 million, so got cut in half. So, when we look at return on capital employed, we generally use EBIT instead of net income. And, that number is much higher in their case. So I mean, I think any way you slice it, you're getting a pretty good deal here.
Yeah. Just a really quick question on the revenue, because we did notice a significant drop, like you said, in 2018 because of the USPS deal fell through. Do you know what percentage of the business is using the USPS?
Well, so I'll give you the numbers. The top line in 2016 was 350. In 2017, it was 449. 2018, it was 567. And then, I'm sorry, what I was reading you was the non-customized post revenue. I'll give you their total revenue: 364, 468, 586, and then 571. So, it took a small haircut, like 2 or 3% in 2019. But the big story here is that their cost of revenue went up from 126 million to 155 million, even though their revenue went down. And then all of their categories for expenses also increased, partly because they bought a company, Metapack, which has lower margins, which affected their margins on their business. So we're not comparing apples to apples anymore, either. But R&D expenses went up. General and administrative expenses went up, and so that effectively halved their EBIT from 2018 to 2019.
Does the company report the revenue segmented by USPS or different partnership deals?
They may in the back. I did not look for that. When I looked at it, I spent most of my time on the financial side, looking at their total company revenues, but that would actually be an interesting thing to look at.
Yeah. Okay, great. So however way you want to slice this, you're talking about a very high return on capital company here.
Yeah,
and this,
look, I think I'm going to clarify something that I said, because I did make a mistake here, because I was looking at EBIT and net income. So on the return on equity side for 2019, net income was 59 million. The equity base was 665. So actually, their return on equity was about 10% for that year, versus 168 over 613 million the year before. So it was almost 25, more than 25% the year before. So it took a huge hit there. But the return on capital employed is still very high. So, but again, we're going to be as conservative as we can. And, I think there's going to be some integration headaches because of they bought the MetaPack and they're going to try and expand the margins there. So I'm still kind of on the sidelines with this business as far as what is 2020, what is 2021 when there's less COVID impact and so on.
Yeah, sounds good. Let's move on to the next question. Does the company have enough cash to maintain its business? So, so this is kind of tightly coupled to the next question, which is does the company maintain reasonable debt level?
Yeah. So cash.
You want to take that one?
Yeah, pretty much cash is solid at 156 million and no debt. So, their current liabilities is 184 million, but their total current assets is 274. So, they have a current ratio greater than 1, which is what our cutoff would be to be concerned. And, no long-term debt to speak of. So, not too concerned about cash here.
I see. Great. And then the last question under financial, which is, can the company generate a strong amount of free cash flow from operation? So talking about free cash flow at the very bottom of the financial statement, cash flow statements, what do you see there?
Yeah, so I mentioned that the net income was 59 million and 2018 it was 168. So the interesting thing about their business is that they have a much higher cash flow, net cash flow out with almost no expenditures relative to their net income. So they have a high expense related to share dilution expenses, so share-based compensation. And so in 2018, their net cash flow from operations was 276 million. And in 2019, that was 137 million. So they generate, relative to their asset base, yes, they generate a nice free cash flow number. But when we talk about the valuation relative to their market cap, it is not a great, ratio.
Interesting. So free cash flow of, even with the drop, you're talking about 135 million, right? With the asset base of 300.
Yep.
That's a really nice ratio right there.
Yeah, I mean the numbers certainly are in your favor from a business standpoint, but I think the bigger risk here is, what is their earnings power going forward, right? It's cheap, to get into this business. It doesn't require a lot of assets, and it generates a nice return. But where is the, are they now going to become more of a commodity business going forward?
Yeah, that's an interesting question, and I'm sure we'll talk about that in the following segments here.
Yep.
So let's move on to the next bundle of question under management. Is the management properly incentivized to protect shareholders' interests over its own? Is there any red flags in terms of management and their incentive structure here?
So let's talk about that a little bit here. The way that they base their compensation is off of, they do a survey of companies with a similar size to theirs by market cap. So market cap for them was, the range that they used was companies that were between $1 billion and $3 billion in market cap. And their share-based compensation, their cash-based compensation for base salary was in the 95th percentile for their CEO. So, if you were thinking about this in 2018 and you looked at their CEO, who's been there for a long time, he's been with the company since 2001 in the CFO role, and then he transitioned to the CEO role, but he's always been on the board. He's getting $888,000, which is about 10% of his total. That's the total compensation for the executive team is about $8 to $12 million, depending on two factors, which are revenue and EBITDA. And so they those are the two metrics that they use, and they essentially slashed their payouts because of COVID. And they said if they hit certain targets, they'll get certain compensations packages. And the variance is between $8 and $12 million for those.
It's interesting because, Charlie Munger talks about this. Show me incentive, I'll show you results.
Yep.
And when you see the incentive structure here, you're talking about revenue and EBITDA.
Yep.
But then this company, what is shockingly good about this company is the operational efficiency. Right? You're seeing what? Basically capital employed to free cash ratio of 2. It's a very nicely greased machine in terms of operational efficiency standpoint. But if I look at the incentive structure, it doesn't really point in that direction. So it's interesting to me the differences here.
Yeah, so I think they are trying to do the right thing with revenue and EBITDA, and as you've heard me say before, EBITDA is kind of a BS metric. In their case, amortization is a non-cash expense. It is what they mark on the income statement, and it doesn't affect their free cash flow. That's why their free cash flow is so much higher than their net income. And depreciation, they don't have money assets, so EBITDA is most likely going to still be similar to their free cash flow. But the interesting thing about this is they're spending heavily on sales and marketing to increase their revenue, right? So obviously the revenue growth is where they're trying to target. And to me, that kind of says, are you going to cut off your nose here to spite your face, right? In order to expand your revenue, but it may not be the best margin revenue that you're going to get. And I don't know that that's the case. I'm just, that's just an observation that I'm having with this, is that you're spending more money on sales and marketing, right? You're spending more money basically across the board. You bought a business in Metapack that has lower margins, right? To kind of add to your growth. And I want to make one thing clear too. That's part of this is their 2018 revenue does not include the Metapack acquisition. 2019 does. So from a overall basis, their revenue actually from an organic basis declined significantly, right? And then they bought Metapack to just kind of, now it looks flat, even though that was mostly because they acquired the Metapack business. So
yeah, it's interesting. It's interesting to think about this incentive question from the perspective of what is happening to the company. What is happening to the company is effectively is that their revenue potential is going down, and people know that. And I think executives and the chair and the board recognizes that there's a lot of competition out there. And so I would suspect that they are placing incentive structure to increase revenue to counter that force, despite the fact that it might counter the well-greased machine that they have created. But I also wonder the incentive structure before the USPS deal fell through.
Yeah.
Were they incentivized to build this well-greased machine, very capital efficient machine before, and then now that the revenue potential is kind of going down, the top line is going down, the board decides to change up the incentive structure so that the top line can grow.
Yeah, and I think there's a couple things here that I want to mention that I'm not going to say that they are doing that intentionally. I think the intent here is to leverage up a little bit and then deleverage as the sales and marketing effort grows. And so that's how they're kind of counteracting the loss of the USPS special package deal, right? So
Getting an Amber Alert?
Yes, sorry about
on
that.
Your phone?
I am, and I had another phone in here that went off first. So, anyway, the point of this is to say, I'm not going to read too much into this incentive structure. I'm going to spend more time thinking. There's a lot of uncertainty to me in how this business is going to come back after losing the U.S. Postal Service special package incentive payment. So let's see. Let's keep moving on.
Sure. Yep. Fair point. Okay, let's move on to the next question. Buybacks or dividends? Any comment there?
No dividends. $60 million authorized in the buyback. They're essentially using the buybacks to offset share dilution from share-based compensation. I mean, I don't think it's a material buyback program. It would be an interesting thing for them to initiate one. But I think they feel like they can leverage up, and that's why they're investing, into a higher headcount and so forth. So hard to tell for me that they're really doing much with my capital, because I think they have a high return and they want to invest in it, into the company.
Makes sense. Last question. Management, open and honest. This one's a hard one.
Yeah, I don't see any red flags there.
Okay. All right, let's move on to the last segment of the checklist, which is valuation. So take us through your assumptions and your margin of safety, the whole 9 yards.
Yeah, so I mean, I'll spoil it right now and say this thing is too expensive. But let me walk through my assumptions first and justify that, because the cash flow basically got cut in half between 2018 and 2019, and the projections that they have for their incentive structure are basically revenue is flat due to COVID. So if we start with an initial cash flow of what their numbers were like in 2018, which I think is being extremely generous to the company, you can get them, in a growth rate of 15%, a discount rate of 10%, and then in years 6 through 10, we're going to say that they cut their growth rate by half to 8%. I can arrive at a intrinsic value of $387 and a margin of safety of $193. So those are very, very generous assumptions, right? But if we look more like the assumptions that I think are going to be more reasonable for a company like this, I'm going to go look at something like closer to, $150 million in free cash flow. But I'm going to try and keep the growth rates. I think it's probably more likely to say like, a number closer to like 10% or 12% for their growth rate for the first 5 years. And I get a margin of safety price of around $95 and an intrinsic value of $191. So it's hard for me to justify the business. They have great returns on capital. They have a lot of things, but I mean, those growth rates to me are being generous, right? I think they lost a big book of business in 2018 to 2019, and I think that it's going to be hard for them to recover. The Metapack business is going to be an interesting thing to see if they can get the gross margins up, and I want to see how the company leverages up, or they've levered up. Now, how does it deleverage when the R&D effort, the increased headcount, how does that impact them going forward? So I am not putting them on the watch list necessarily, but I think that they may be in an intermediate category where this could be a very interesting business, and I may want to look at them again next year, see how they do during COVID, see how they do during this transition period away from more to they don't have the special deal in place anymore, and let's see what they look like.
Yeah, certainly there's a lot of uncertainty around the business right now, because obviously the COVID-19 for all businesses, but especially this one, with the fact that they lost major source of revenue in 2018, and they're really trying to figure out how to grow their business again. So a lot of uncertainty, but also the bright side is that this is a very well run company. Again, the capital efficiency is very, very high. For me, though, for me though, Hari, I think it goes back to the fundamental of this analysis, which is competitive advantage. And I think you nailed it in the head. They're kind of a commodity business at this point. And so thinking about it from the long-term perspective, perhaps for me at least, it's not something, like you said, on my radar, but certainly it could be a very interesting play in a more of a cigar butt type kind of play when the stock price actually goes down even further from here.
Yeah, I mean, in December, I think you could have bought this company at around under $100 a share. That was right after they announced the Postal Service stuff and things like that. So, they took a big haircut then. So right now, I don't know if that's the same, at $200 a share, there's too much, it's a speculative business at this point, right? I don't know what the future is going to hold. It's not a compounding machine. It's not anything like that. And they made an acquisition that, lowered their margins, and maybe they're going to be able to integrate it well. But it's in a market that is not as familiar territory to them in Europe. And so, what is that going to look like? I don't know, and, I tend to want to look at businesses like when we talked about Visa, right? Visa is everywhere you want to be, essentially, right? That's their tagline. And that even in the COVID crisis, Visa is going to do fine, right? No matter what you throw at Visa, they're going to be okay, right? I mean, they basically have an impenetrable moat. Here, I see this as more of commoditized business. They don't have a low-cost solution anymore that they can offer. And so now they're competing on feature set, which is still, I think, is an advantage for them. But I don't know that it's enough of an advantage that, they're just going to be looking at lower margins, lower return on capital going forward. So,
yeah. Thanks for covering all of that, Hari. I think it was a interesting company for sure. Something to, an interesting exploration of the space for me. I didn't really know about the space at all. So thank you for going through that. Awesome. So that was stamps.com. Again, as I said in the earlier part of the episode, this was a company that was suggested to us by one of you guys, our listeners. So if you guys have a company that you want us to analyze, email us at info@valueinvestor.org. We'd be happy to take a look.
Yeah, and also, if you want to interact with us on our Slack channel, send an email, info@valueinvestor.org. You can send us, talk to us in real time, get the checklist, ask Becco for dating advice, whatever you want, info@valueinvestor.org. So,
Awesome. All right.
And you can also send Becco comments about the beard too. So
awesome. Great. Thanks a lot. Thanks you guys. Thanks a lot for joining us. I hope you guys stay safe out there. And we'll see you on the next episode.
Thanks.